Welcome back to The Deep Dive. We're the show that helps you get those shortcuts to being, well, genuinely well-informed. We tackle the big topics, make them clear, maybe even share a laugh. And today, we're diving deep into something really practical, but also, surprisingly philosophical. It's excerpts from Tom Hougaard's The Trading Manual.
That's right. And our mission today really is to pull out the key insights from this guide. Think of it as a blueprint for anyone looking at the financial markets. Doesn't matter if you're just starting out or, you've been doing it a while and want to sharpen your skills.
And Hougaard, he comes out swinging with some pretty bold claims right away. He says, 76% to 79% of brokerage clients?
Yeah, they're unprofitable. He even mentions a brokerage linked to a big seminar company where people paid like £3,000 for training. And still, 79% were losing money.
Wow. So it kind of sets up his whole angle, doesn't it? Like maybe the standard approach, more courses equals success. Maybe that's not the full picture.
Exactly. And what's really key here is he says, this manual, it's free, he's very clear, not a sales pitch for something I sell. He's putting his name on it, saying he makes his money from trading itself.
Which puts him in that top 20% bracket, he says.
Right. But then he makes this crucial distinction. He says the people really making a living aren't the 20%. It's the 1%.
The 1%. Okay, so he's aiming high and suggesting his methods are geared towards that elite level. So, okay, let's unpack this. With claims like that, why should we listen to Tom Hougaard? What's his credibility based on?
Well, he's pretty open about his results. He talks about audited competitions. 1 year, taking into account from £25,000 to almost £1 million.
£1 million? Seriously?
That's what he states, yeah. And claims of no losing years, always over 100% return. He says journalists checked his statements, real money. Plus, he spent years working at a brokerage, running live trading rooms. So he saw firsthand what mistakes they're making over and over. That's valuable insight, seeing the common traps.
And here's where it gets really interesting for me. He says, flat out, I am not talented. I am trained. I work from a structure.
That hits hard, right? Challenges that whole trading genius myth.
Totally. It makes it feel more accessible somehow.
So how does he frame this playbook idea, this structure that anyone can supposedly use, maybe even better than those expensive weekend courses he mentions?
Well, he presents the manual as that playbook. It's designed to give you a plan, a structure to follow. He implies it's more valuable than dropping, say, £3,000 on a short course, but he doesn't sugarcoat it. There's a warning right there. This is not an easy profession.
Okay, good dose of reality there.
Yeah. The money is good, but the path is going to challenge you in ways you never imagined. He's clear. Master the process first, the money comes later. And definitely don't trade with money you can't afford to lose. That's fundamental.
Right, the classic advice, but sounds like he really hammers it home. So if it's about training and structure, not talent, what are the building blocks? What's actually in this playbook? Okay, so he breaks it down into 5 key knowledge areas. You've got strategy knowledge, devising your own methods. Market knowledge, understanding different markets like Forex, indices, whatever. Then instrument knowledge, how to actually place trades. Technical knowledge, reading charts, knowing how to buy, sell short. And finally, the big one, psychology.
Psychology. You mentioned that was key.
Oh, absolutely key.
Yeah.
This is maybe the most striking claim. He says trading is 10% technique and 90% psychology.
90%. That completely flips the usual script, doesn't it? Makes you think differently about where to focus your energy.
It really does. And he talks about practice, too. So start in a demo account, sure, but only for a few days. Just get used to the platform buttons. Then you got to move to real trading, real money. Even if it's tiny amounts, that's where you actually develop the skills and, crucially, feel the psychological pressure.
That makes sense. Feeling the heat. He also talks about the market's rhythm, right? The 24-hour cycle isn't uniform.
Exactly. It's not linear. He points out the busy times Europe opening at 8 a.m. UK time, the U.S. stock market open at 2:3 p.m. That's when the action tends to happen.
And how do these different sessions interact? Like, how do U.S. traders react to what happened in Europe?
Yeah, he covers that. Says U.S. traders basically do one of 3 things. They agree with Europe's trend and push it further. They disagree and reverse it. Or sometimes they just don't care and do their own thing. He also flags earnings season January, April, July, October as a time of heightened volatility, especially with big Dow stocks like Boeing or Goldman Sachs.
Right. Those can move the whole index.
They account for like 16% of the Dow. So their earnings can cause huge swings, hundreds of points sometimes. Exciting, but definitely risky if you're not prepared.
Okay, so let's dive into the mechanics, the nitty-gritty of how markets move. He talks a lot about technical analysis, price action. Sounds complex, but the ideas go way back, yeah.
Way back. Some trace price action concepts to 16th century Japan, believe it or not. But the core ideas he focuses on are pretty clear, like defining an uptrend. You need higher highs and higher lows. Simple. A downtrend. Lower highs and lower lows.
Okay, basics.
Right. And selling short. That just means selling something now, hoping to buy it back cheaper later. You profit from the price dropping.
And how does he define when a trend actually changes?
Very specifically, for an uptrend to change to a downtrend, you need to see the market make a lower low, then a lower high, and then turn down from that lower high. It's that sequence.
Got it. But markets don't always trend neatly, do they? Sometimes they just bounce around.
Exactly. He calls those range-bound or ranging markets. Price just chops sideways between a ceiling and a floor, and you need strategies for both trending and ranging markets. It's not one size fits all.
This leads to a really fundamental point he makes, maybe the most fundamental. What's actually real in the market?
Yeah, this is huge. His firm belief is price is the only real truth in the market. Price never lies. It can't.
Price never lies. That's quite a statement. It sort of strips away all the opinions, the news, the noise.
It does. It challenges you to just look at what the market is doing, not what you think it should be doing. He builds his principles around this. 4 key principles of price action. Trends tend to persist, trends end in specific ways, and markets alternate between ranging and trending.
Okay, this next bit really messes with your head, or at least your everyday logic about value. How does he explain the concept of price in the market versus, say, shopping?
Yeah, the supermarket analogy. If butter's half price, you think, great, cheap, stock up.
Of course, bargain hunting.
But he says, in the markets, forget it. No, there's no such thing as cheap. There's no such thing as expensive either. There's just the price.
Just the price.
Just the price. He tells this painful story about Northern Rock stock. Peaked at 1,200 pence. An investor kept buying it as it fell, thinking it was getting cheaper and cheaper.
Oh, no.
Yeah. It went to zero. The market didn't care about cheap. The price just kept going down.
Wow. That's a brutal lesson in market reality versus our perception of value.
It is. And it connects to his point that the markets are irrational to a rational human being. Our logic says buy low, sell high. But in trending markets, traders have to train themselves to do the opposite sometimes, to buy something because it's already gone up, because the trend is likely to persist.
Like with Lehman Brothers, he mentioned.
Exactly. It got cheaper and cheaper every single day until the day it was worth nothing. The market just kept trending down, ignoring any idea of intrinsic value.
So if cheap and expensive are illusions and trends persist, what's the practical takeaway? Principle 2, right? Follow the herd.
Pretty much. Follow the herd, follow the trend. But he adds nuance. He talks about fading the short-term trend if it goes against the long-term trend.
Okay, explain fading.
So imagine the main trend on the daily chart is strongly up. But on the, say, 60-minute chart, there's a little pullback, the dip downwards. Fading that dip means you'd actually buy into that short-term weakness, betting that the larger daily uptrend will take over again. You're going against the immediate move to follow the bigger picture.
Interesting. And what about the end of trends? He has a principle for that too.
Right. Principle 3. Trends end. And his mentor personally had this saying, 90% of the move comes in the last 10% of the trend, time-wise.
Wow, the final surge.
Yeah, that explosive final phase. He says trend endings are often marked by hitting significant price levels, old highs or lows, big round numbers, also volume spikes, or real emotional extremes.
Like the Bitcoin example.
Exactly. The frenzy and hype around Christmas 2017, followed by that massive 70% drop. Classic emotional peak marking a top. And principle 4 is just that market cycle, ranging to trending to ranging. They move between periods of consolidation and periods of directional movement. Professionals aim to trade with the long-term trend during the trending phases.
Okay, principles are great, but how do you actually see these trends and turning points on a chart? What tools does he suggest?
He keeps it pretty simple, actually. He introduces something called the 3-bar price swing chart.
3-bar price swing.
Basically, you look at the highest high and lowest low of the last 3 or 4 days. The chart mechanically draws lines connecting these swings. If it's making higher swing highs and lows, it's an uptrend. Lower swing lows and highs, downtrend. It's visual and removes guesswork.
Mechanical. I like that. Less subjective.
Exactly. He also mentions basic trend lines, drawing lines connecting lows in an uptrend, support, or highs in a downtrend, resistance. And he shares a little secret. Draw a trend line, then just copy and paste it, moving the copy to parallel other highs or lows.
Yeah.
He says this can often pinpoint other potential turning points or target areas.
Huh. Clever trick. Okay, so let's get really practical now. How does a trader like Hougaard actually apply this day to day? What's the routine, the specific instruments?
Well, he focuses. For swing trading, holding trades for days or weeks, he mainly looks at a handful of major currency pairs. Euro dollar, sterling dollar, dollar Swiss, dollar yen, euro yen, sterling yen.
Why so few?
To really learn their quirks, their individual personalities, how they tend to move. Familiarity breeds understanding. For day trading, even fewer. Sterling dollar, euro yen, and he uses multiple time frames. The weekly chart gives the great overview, often with an 89 period moving average just to see the long-term flow.
89, okay. Specific number.
Yeah, it's a Fibonacci number, sometimes used in technical analysis. Then the daily chart is crucial for his 3-day rule and identifying the main trend. And for finer detail, and actually timing entries, he'll drill down to 1 hour, 4 hour charts for swings, or even 10-minute, 15-minute, 5-minute, 1-minute charts for day trading, engaging the immediate momentum.
Right, zooming in and out. Now, you mentioned charts. He dives deep into candlestick charting, calling it a pattern recognition system. But he also warns against hype, right? No secret patterns.
Exactly. He's pragmatic. He says, understanding candlesticks gives you early clues when the balance of power is shifting between buyers and sellers. It's not magic, it's reading the story of the price bar.
So what parts of the candle tell that story?
2 main parts. The body, the thick part, showing the range between the open and closed price. A big green body means buyers were strongly in control. Big red, sellers dominated. And then the shadows, or tails, the thin lines sticking out, they show the extreme highs and lows reached during that candle's time period. Long shadows can indicate a struggle, a power shift, uncertainty.
And he boils it down to just a few key patterns.
Yeah, he focuses on the essential 8 candle patterns, things like the standard candle, spinning tops, small body, long shadows, indecision, various dojis like long-legged, gravestone, dragonfly, more extreme indecision, and the umbrella pattern like the hanging man or hammer potential reversals. He particularly highlights the engulfing line pattern.
Engulfing?
Yeah, it's a strong 2-bar reversal signal. You have one candle, then the next candle has a much larger body that completely engulfs the body of the first one. If a big green candle engulfs a prior red one, that's bullish. Vice versa for bearish. It shows a sudden, powerful shift.
Okay, that seems quite clear visually. Now, here's something that sounds intriguing. Fake moves. He calls them fake outs and fake downs. What's going on there?
Ah, yes. This is where the market pushes just above a previous high, or just below a previous low, sucking people in, only to sharply reverse direction.
Ouch. Trapping traders.
Exactly. It looks like a breakout. People jump on board and then wham, it snaps back. He says these fake moves work really well across many time frames and are powerful signals if you recognize them for what they are.
So how does he use patterns like the engulfing line in practice, say, for day trading indices like the FTSE or DAX?
He uses them to find clear entry points and manage risk. He lays out 3 ways to enter on an engulfing pattern. 1, aggressive jump in before the candle even closes, assuming the pattern will complete. High risk, potentially high reward. 2, normal, wait for the engulfing handle to fully close, confirming the pattern, then enter. More standard. 3, cautious, wait for the next candle after the engulfing one to trade beyond the high for a buy or low for a sell of the engulfing candle. Extra confirmation, but you might miss some of the move.
Right. Different risk appetites. And exiting the trade.
Several criteria. Move your stop loss to break even once the trade moves in your favor. Trail the stop loss progressively as the trend continues. Tighten the stop if you see new opposing candle patterns, like a doji, suggesting indecision. Or simply take profit if price spikes into a known support or resistance level, especially on high volume.
Okay, that's quite a structured approach to managing the trade. He also introduces another specific entry technique, the 4-bar fractal.
Right.
Sounds mathematical.
It's actually quite simple and visual. A fractal is just a specific pattern of candles indicating a potential turning point. For a bifractal, you need a candle with a low that's lower than the lows of the 2 candles immediately before it and the 2 candles immediately after it.
So a little V-shaped bottom made of 5 candles in total.
Essentially, yes. A 4-bar fractal is slightly different, using 4 candles, I believe, but the principle is the same. A mechanical way to identify a short-term pivot point. It works on any time frame, but he says it has more impact on longer ones, like daily or weekly charts.
And he combines this with divergence strategies?
Yes, this is powerful. Divergence was apparently thought up by a trader at JP Morgan. It's when the price itself makes a new high, let's say. But an oscillator, like the stochastics indicator he mentions, which measures momentum or overbought, oversold conditions, fails to make a new high along with the price.
So the price is pushing higher, but the underlying momentum isn't confirming it, like it's running out of steam.
Exactly. The indicator is diverging from the price. It's a warning sign that the trend might be weakening or about to reverse. So when you see this divergence and then get a 4-bar fractal buy or sell signal confirming it, that's a high probability entry signal for him.
Divergence plus fractal confirmation. Got it. Okay, we've covered trends, patterns, entries, but you said earlier he believes 90% of trading is psychology. Let's talk about that bedrock, risk management and the inner game.
Absolutely crucial. His number one non-negotiable, most important rule of all.
Let me guess. Stop loss.
You got it.
Yeah.
Don't ever trade without a stop loss. Period.
So how do you determine your stop loss and position size?
He gives you 5 critical questions to answer before any trade. What's my entry price? Where's my stop loss going? How much am I risking per point or pip? What's my total account size? And what percentage of my account am I risking on this single trade?
That forces discipline.
Totally. He used an example. A 1,000-pound account, you decide to risk 5%, which is 50 pounds. You want to trade the DAX, entry at 7,920, stop at 7,910. That's a 10-point risk. Your 50-pound risk budget divided by 10 points means you can risk 5 pounds per point on that trade. It calculates your position size based on your acceptable risk.
Very clear. And managing trades once they're profitable, he has different philosophies there, right? Scaling out versus scaling in.
Yeah, 2 main approaches. Scaling out is common. You take partial profits as the trade moves in your favor. Lock in some gains. Many teach this. But he actually doesn't do it. He sees it as a psychological limitation, like you're capping your winners.
Interesting. So what does he prefer?
He prefers scaling in. Start with a small position, and if it proves you right and moves strongly in your favor, you add to the winning position.
Adding to winners. That sounds counterintuitive to locking in profit.
It is for many, but he argues this is how you achieve those gigantic profits. It might lower your overall win rate because adding can sometimes turn a winner into a bigger loser if it reverses. But the wins, when they work, can be significantly larger. It requires confidence and, again, strict risk management on the adds.
Confidence, right.
Yeah.
Which brings us back to practice. What's his final take on demo accounts, given the psychological element? Helpful or harmful?
Nuanced. Advantages. Yeah, learn the platform buttons, practice placing orders without costly mistakes, you get comfortable. Disadvantages, though.
Right.
It's fake money. There's no real emotional sting when you lose. You can develop bad habits, take unrealistic risks, get a false sense of security.
This doesn't feel real.
Exactly. So his advice, use demo briefly, just for the mechanics. Then switch to real money, even if it's tiny stakes, micro lots, minimum size. Feel the pressure. That's the only way to truly learn the psychological side. He mentions a 20-year-old medical student who succeeded because he treated his demo account like it was real, then transitioned smoothly. It's about the mindset you bring to it.
The mindset.
Yeah.
Which leads perfectly into what he calls the untrained trader's paradox.
Right.
Scared when they should be hopeful, hopeful when they should be scared. Why do so many fail, according to him? Is it self-sabotage?
He argues no, it's not some unconscious wish to spoil their efforts. It's much more concrete. Lack of knowledge, poor risk controls, like no stop losses, not enough capital to withstand losses, no proper instruction or mentoring, and no solid, tested strategies. It's practical failings.
So success is more formulaic.
In a way, he defines it as a trading strategy with an edge, meaning it has a positive expectancy over time, plus the ability to be able to consistently apply the strategy. You need both parts, the edge and the discipline to execute it.
Okay, and here's where the psychology really bites. He lists 4 major trading fears: being wrong, losing money, missing out, FOMO, and leaving money on the table. But the biggest one he tackles is the need to be right. Why is that so dangerous?
Because it shifts your focus. Newcomers, he says, are obsessed with being right on every trade. Professionals just want to make money over the long run. They accept they'll be wrong often.
The ego gets involved.
Totally. He uses that great quote. It's not what you don't know that gets you into trouble. It's what you think you know for sure that just isn't so that gets you into trouble. Believing your system is perfect or that this trade just has to work. He stresses, no system is perfect. Losses are part of the game. Accept them gracefully. Learn from them. Remember that calculation.
The 25% one.
Yeah. If your average winner is 3 times your average loser, you only need to be right 25% of the time to be breaking even gross. That frees you from needing to win every time.
So it's about probabilities, not predictions. What about high standards? Does that mean perfectionism?
Yeah, quite the opposite. High standards means high discipline and following your plan, not demanding perfect results on every trade. Avoid analysis paralysis overthinking until you're frozen. Don't beat yourself up for missing a move. The key is having a detailed trading plan and sticking to it. He distinguishes between a justified loss, one that happened while following your rules, and an unjustified win, where you broke your rules but got lucky. The latter is actually more dangerous long term.
That's a powerful distinction. Follow the process, not the outcome. This all seems to boil down to his personal mantra, the one on his Post-it note.
Control your mind, control your future. Simple but profound. He argues your mind is your greatest asset or your worst liability in trading. It needs daily discipline.
And that quote about extraordinary effort.
Yeah. If you want what you don't have, it will require something out of the ordinary. Extraordinary effort leads to extraordinary results. It applies to anything tough, not just trading. You have to put in the work, especially on the mental side.
He also brings in ideas from others, like the importance of physical well-being.
Right. A high-energy life, referencing Steve Ward's work. For peak performance, focus, handling stress, you need to be physically and mentally fit. It's demanding work. And then there's deliberate practice. He cites trader Linda Rashka advising someone to just watch a 5-minute chart of one instrument for a whole week. Just observe. Learn its rhythm.
Intense focus.
And Anders Ericsson's famous research showing that expertise comes from thousands of hours, 10 years or more of this focused, deliberate practice, not just raw talent or genetics. Master one thing first. He even shares a couple of his own recent trades, one small loss where he learned about being impatient, and one big win that came from patience and scaling into the winning position. Real examples of the principles in action.
So, wrapping this all up, what does this deep dive into Hougaard's manual mean for you, the listener? Whether you're trading or learning any complex skill, it feels broader than just finance.
It absolutely is. The core message isn't really about secret indicators or magic formulas. It's that success, certainly in trading, maybe in many fields, hinges less on innate gifts and much more on building a disciplined structure, relentlessly mastering your own psychology, and committing to continuous, focused, deliberate practice. It's about intentional learning and self-management.
So we've had a peek behind the curtain today, from the mechanics of price action to the critical importance of mastering your own mind.
And maybe a final thought to leave you with, something the author uses an image. You will never see a U-Haul after a hearse.
Provocative.
It makes you think, doesn't it? What does that mean for your pursuit of goals, financial or otherwise? And crucially, what extraordinary effort are you willing to put in, mentally and practically, to achieve what you truly want to master?